The US finds itself at an interesting crossroads, at least from a trading perspective. The Dow Jones was dragged from its recent 27,600 passing highs by renewed fears about the global economic downturn and the increased likelihood of a second wave of coronavirus cases, falling all the way under 25,850. With Trump never really getting a handle of the pandemic domestically, a troubling 29 states reported increases in their 7-day average of new reported cases over the weekend, following the easing restrictions of the last month or so. This led the White House to admit the government is preparing to deal with a potential second wave in autumn. It is perhaps disingenuous to call it a potential second wave, however, given America's inability to get the first wave under control in any way, shape, or form. It's really more of an extension of the situation we've seen over the last couple of months, with the sort of a laissez-faire attitude to the virus, meaning that you've got differing situations on a state-by-state basis and no real cohesive nationwide plan for dealing with the illness. All this comes not long after China put Beijing on lockdown due to a new outbreak in the capital. The city officially lasted just one single day without COVID-19 before the virus came roaring back, and the real strict lockdown measures were put back onto the city. Germany has also joined the fray, with the company's all-important R rate crossing the crucial 1 level as more than 1,000 abattoir workers were revealed to have the illness. Yet investors did also get to indulge in a bit of optimism last week, with reports that President Trump is preparing a $1 trillion infrastructure spending plan, a project that the president has long wanted to push forward with. In a far greater form, I think the initial push for this plan was in $2 trillion. But he couldn't agree with funding with the Democrats. Now he can claim that he's trying to revitalise the US economy as he tries to get the scheme over the line, something that might help with the funding issue this time out. Since those initial reports, however, details have been thin on the ground. Ideally, then, this week will bring with it a more substantial update on the likelihood of such a plan being implemented, especially on the issue of funding, which, like I said, sank previous attempts at this kind of stimulus. The US government does go into recess at the start of July, so there's not a whole lot of time for this to be implemented in the coming week or so, which means that markets might be slightly more susceptible to second wave coronavirus case news if there isn't something to distract from that as the week goes on and the situation gets worse in the US, as it does seem to appear like it's going to do, given the sheer number of cases over the weekend. While investors keep an eye on both the stimulus and second wave headlines, there's plenty of data for the markets to process this week. Existing home sales are out on Monday, followed by the month's flash manufacturing and services PMIs on Tuesday. The manufacturing PMI is expected to see a fairly healthy rebound from 39.8 to 50.0 month on month, while the services figure is expected to come in at 46.9 against the previous month's 37.5. The final first quarter GDP reading is then on Thursday. That's expected to remain at minus 5.0%, though last time out, the second estimate of this reading was revised lower, so it'll be interesting to see if that's the case again on Thursday. Whilst unemployment claims on Thursday are forecast to drop to 1.3 million, which will be the lowest since they exploded in March, but still staggering and unprecedented compared to the kind of figures seen previously. On Friday, then finally, the Fed favourite core PCE price index figure is expected to jump from minus 0.4% to 0.0%, with the revised consumer sentiment number expected to creep up from 78.9 to 79.1.